Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Let me ask you this, are you charitably inclined? Some of you might say, no, I'm more family inclined. But let me tell you this, is that we're all charitably inclined. It's just going to the IRS if you're not giving it to a charity. Welcome to the show, folks. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with the big man, Big Al Clopine. He's sitting right over there. We're going to talk about some different ways and strategies to figure some stuff out, because if you plan a gift, the IRS will forgive a tax. So would you rather give your dollars to the IRS, or would you rather give them to a cause that you're really passionate about? That's what's on my mind today. Most of you hate taxes. Can't stand them. I do not want to pay any more than my fair share. Well, let's look at this. If you plan a gift, like I said, the IRS will forgive a tax. And if you give to a charity, look at what people feel like. They feel wonderful about themselves. 60% felt hopeful that they were making a difference. 43%, you know what, they're feeling really good about themselves, and 48% felt satisfied. I'll tell you what, if I asked you, did you feel satisfied by giving that big fat check to the IRS? I would say 100% of you would say no, I did not feel satisfied by giving that much money to the IRS. Let's bring in the CPA, the big man, to kind of work things out for us to figure out, all right, well, what is this plan giving? What is charitable giving? And how does it save me money in taxes, as well as a good cause that you can give to something that you care about? Big Al? Alan Clopine, there's great causes out there, and I think first and foremost, people should give because they're looking to make a difference. But also, if you do give, right, there is some tax benefits behind it.
Completely agreed, Joe. I mean, the reason that we give is because there's causes that we feel passionate about. We want to help them out. It's a way to make our world a better place. That's a given, right? Now, there's also a tax deduction. So that's what we want to get into today, because there's ways to maximize that tax deduction depending upon your situation. So we're going to start out by talking about different ways to give, different methods, if you will. Some of them you may know, some you may not know. And then we're going to, next segment, get a little bit more advanced. We're going to get into something called a donor-advised fund, which is actually a special way to give, in fact, future year contributions, deducting them in the current year. This is actually a pretty cool thing. And then a charitable remainder trust. This is for folks that have property that's appreciated. Like, let's say, I don't know, a piece of real estate. If they sell it, they get a big gain. If they put it in charitable trust, there is no tax to pay, and they get a lifetime earning stream. So that's actually a really good one too. But Joe, to start out, maybe we'll just kind of get into the basics, you know, in terms of what are the tax deductions and how do you give?
Right, and it's like, do I give cash? Do I give appreciated stock?
Right.
And how do I report all of this stuff? So let's start there, Al.
Yeah, so typically we think of giving as cash or check. That's one way to go. A second way is appreciated stock. So believe it or not, you bought a stock, let's say for $1,000, and now it's worth $10,000. When you give away the stock, you get a deduction for $10,000, and you don't have to pay the tax on that gain. So that's actually a better way to give, because you're avoiding a capital gain tax. And of course, also, we know we can volunteer our time, and that's part of that feel-good thing, Joe, that 60% felt hopeful that they're making a difference.
Right, and I think a lot of people do that. I mean, giving away your time is sometimes the most valuable gift that you can possibly give. Now, let's just say if you would like to give a check or cash. I mean, so, all right, well, how do you report this, and what are some things that people got to look at?
Yeah, I would say right off the bat, checks are definitely preferred because you have a proof of the donation. And I will say this, whether it's cash or checks, any donations over $250, even to any one organization, even if you write a check, you have to have a letter from that organization acknowledging that donation. That's part of the new reporting rules. It probably came around, I don't know, 5, 6, 7 years ago. If you don't have that proof from the charity and you claim it on your return and you're audited, that will likely be disallowed.
You know, the best way to give, and if you take a look at this, I think a lot of people make mistakes here, is that you can give appreciated stock, right? So we see, all right, on your tax return, you gave $20,000, $30,000 this year, but you also had a stock that had $20,000 or $30,000 of capital appreciation. You could give those stocks to those charities. You don't pay any tax. You get a full deduction, right? And then that charity sells the stock, they don't pay any tax, and then they can use those funds as they wish. So looking at how you're going to give to those overall organizations, you want to take a look at your balance sheet. If you have a lot of cash, that's great, but if you also have appreciated stock, and of course this has to be outside of your retirement account, that you can avoid those capital gains tax by giving those stocks directly to the charity. And Al, I think that's probably a little bit better way to go than just cutting a check of cash if they do have that appreciated stock.
Well, that's right, Joe, because when you give cash, you've already paid taxes on that to get that money. So when it's appreciated stock, it could even be real property. It could be a rental property or something like that. You can give that property, that stock, and pay no tax on that gain. So not every charity will accept appreciated property, but a lot of them will. Because when it's a charity, when they get that appreciated stock, they get the same tax basis as you, but since they're a nonprofit, when they sell it, they don't pay any taxes on the gain.
Right, and you could buy that stock back, right? So if you had a highly appreciated stock, so you give that to the charity, and then you just buy the stock back, and then now you have a higher basis. Then if that stock continues to grow, that tax that you pay is going to be a lot less because you gave that appreciated basis or appreciation to the charity. So there's different things to look at when you are giving to a charity or an organization, but you can maximize the overall tax deductions with this, and then you can use some combinations of different strategies to really maximize your overall retirement, your cash flow, your income, or whatever your goals really are. Hey, we got to take a break. We're going to dive into a little bit more technical ways of giving, such as a donor advised fund. A lot of you might not have heard of this before, but if you ever thought about setting up a private foundation but didn't want to pay the huge checks to set this thing up, stick around, because you can do that. You can have a little mini private foundation for a very cheap cost and give to several different organizations of your choose and feel good about yourself. So don't go anywhere. The show's called Your Money, Your Wealth.
I'm Matt Horsley, Certified Financial Planner with Pure Financial Advisors. Did you know that roughly half the U.S. households age 55 or older have absolutely no retirement savings whatsoever? That's according to the Government Accountability Office.
Welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out today talking about charitable planning. Before we dive in, we got some pretty good stuff this segment. Donor Advised Fund, Charitable Remainder Trust. Some of you might have heard of this, some of you have not. So stick around, we'll fill it out for you. Let's go to the true false first.
I can avoid paying capital gains taxes on my rental property that appreciated in value if I donate to a charity. I can also get a tax deduction for several years to come for the property. And the answer to that is true, and let me explain. So first of all, you can, as we mentioned last segment, you can give away a property, real property, rental property, whatever, and whatever gain is in that, you don't have to pay tax on that, and in fact, you get a tax deduction for the fair market value of that property on the date of the donation. Now realize this, there's a couple limitations. So based upon your total income, let's say your total income is $100,000, you're going to be limited to 30% of that, or $30,000 as a charitable deduction in the current year. But any additional amount will carry over into next year's return, and it carries over for a period of 5 more years. So you can take the deduction in the first year and 5 more years thereafter, so it's 6 years to be able to take that deduction fully. So for those of you that have properties, you don't want to sell them because they're gains, you don't necessarily need the money, charity could be a great way to go.
Hey, and so, Al, that 30% is cash is a little bit different, correct?
That's correct. So if you give cash or check, it's 50% of your adjusted gross income. So $100,000 of income, you could give away $50,000. So there's different limitations depending upon what kind of asset you give away.
You know, here's something that happens quite a bit, is that a lot of you are given to charity each and every year. And as you approach retirement, you might be in very high income years over the next 2 or 3 years. And then as you approach retirement, your income might go down a little bit. Or maybe that you exercise some stock options, or you got a large bonus or something like that. Here's a cool strategy that you might want to consider. This is called a donor advised fund. And so let's say that you're giving $10,000 a year, and you plan on giving that $10,000 a year to a local charity or church or whatever it is. And this year, you'll probably need the tax deduction a little bit more than next year because you have a high income year. Well, what you can do is you can bunch up, let's just say 5 years of contributions. So you take $50,000, right? So you are the donor here. And you could put cash into this thing. You could put highly appreciated stock, other assets. It goes into this fund. It's almost like a family foundation. You manage these assets. So now you have $50,000 into this donor advised fund. And guess what? You get a $50,000 tax deduction that year. Then next year you give $10,000 out of the donor advised fund. The following year you give another $10,000, or maybe you want to give $15,000 or $5,000, whatever it is. You have control on where you're giving your money to and how much that you give. But the point is that I can, as a donor, put money into this donor advised fund and get a fairly large tax deduction. Al, we use this strategy quite a bit with our clients, and it does amazing things from a tax perspective, but also it gives the client control and still be able to give to the quality charities that they love.
Well, we do, Joe, and we find this is a real popular technique if, in fact, you're charitably inclined. If you're not charitably inclined, then it doesn't really matter. But if you normally give to charity and you have a high income year, Joe, as you just said, maybe you had stock options that you exercised, or maybe you sold a property, or maybe this is your last year working and you're going to be in a much higher tax bracket. Those tax deductions might be more valuable to you this year, so you go ahead and put some money in a donor advised fund. Whatever you put in, you get a tax deduction. Realize those limitations that I just mentioned, but you get a current tax deduction while you're in a higher bracket. Now, once the money goes in, it's a one-way street. You can't pull it back out, so don't put too much in. So it's going to charity and it's going to stay with charity, but you get to decide what charities get what amounts over your lifetime, and there's no minimum or maximums. You could let that thing grow 20 years, you could start distributing it right away. So it's a very, very good tool.
Right, and you can go to Fidelity, TD Ameritrade, Charles Schwab, you know, all of the major custodians in the big brokerage firms will have this, and it's fairly inexpensive. Right, so if you try to set up a family foundation, Al, I mean, you're talking thousands and thousands of dollars just to set it up, different tax returns, and there's a lot of administration headaches there. But now if you look at, hey, well, I want to take the tax deduction today, but I also want to control the assets and then dole those assets out at my choosing, this might be a pretty good option for some people, of course, if you're charitably inclined. So you want to look, do I have a high income year? And if I'm giving to charity, you can bunch those charitable gifts all in 1 year, get that tax deduction in 1 year, control the assets, and then dole them out.
Well, Joe, as you say, it is very much like a private foundation. It works the same way, except you don't have to set up an entity. It's simply an account that you set up. Very easy to do. So that's a good one. Now, I want to switch gears just a little bit because for some of you, you've got rental property you've owned for years. You'd like to sell it because you want to get out of being in the landlord business, but you don't want to sell because there's too much taxable gain. Here's a strategy that might be fantastic for you. It's called a charitable remainder trust. And with a charitable remainder trust, here's how it works. You contribute the asset to the trust, first of all, and then the trust sells the asset, and because it's a charitable trust, it's tax exempt, it pays no tax. You receive an immediate tax deduction for a portion of that gift, usually 10% of the value of the property, and most importantly, is you receive income and principal payments over your lifetime. And if you're married, it's over you and your spouse's lifetime. It's a great way to sell an asset, pay no current tax, have all of that asset working for you, and then you get a lifetime earnings stream to boot.
Right, if you take a look at it like this, let's say that you have $1 million property, right? So you got $1 million, and let's say you depreciate it down to nothing, so you have $1 million gain. Well, a lot of people don't want to sell that because it's like, okay, I got depreciation recapture, I got capital gains tax, I got the new net investment income tax, I got state tax. I might lose 40% of that. So now I'm only working with $600,000. I don't want to cut a $400,000 check to the IRS. Now, if I do this, I take this $1 million and I throw this into this charitable remainder trust. All right, what this is going to happen is now that charitable trust is going to kick me out an income stream. Okay? So you sell the property, the trust pays zero tax. It pays zero tax because it's a tax exempt entity. The $1 million property, boom, it's in the trust. They sell it, and all of a sudden you can work now on $1 million versus $600,000. Just think about how much more income that you can receive off of $1 million versus $600,000. It's simple math. Here's the caveat, is that now 10% of this asset will go to the charity. So you get 90% back in most cases if you live until life expectancy. So you can set these trusts up in multiple ways. I'm just using this as a very simple illustration. I have $1 million property. I don't want to pay tax on it. I throw it in this trust. It could be a tax-exempt trust, a charitable remainder trust, whatever that you want to call it. Then the charity will get the remainder, which is usually 10%. So then you get the $900,000 back plus the growth as an income stream for the rest of your life. The charity gets their piece, and then here's another kicker to boot. Because I put $1 million property in here, I also get what? Look at this, $100,000 tax deduction that given year. I put $1 million in, I get an income stream, the charity gets theirs, plus I get a $100,000 tax deduction. This strategy works very well for a lot of different people. You just need to look at it to see what are the rules, how does it apply to my overall situation, because then you can take this tax deduction and start doing pretty cool things, Al.
Yeah, there's no question, Joe, and this is what we call a bet to live strategy. So
yeah, you want to live, because if you die, right, let's say you put it in the next day and then you die, well then everything is going to go to the charity.
Yeah, and that's really a key point. So in other words, you put the asset in the trust. Whenever, if let's say you're married, when the two of you pass away at some point, one maybe first, one second, whatever's left in the trust at that time goes to charity. So if you only live another couple of years after you do that, then charity is going to get the majority of the asset, right? So on the other hand, if you live past life expectancy, charity may get a lot less than 10%. So that's how these things are set up generally. So if you think you have a long life expectancy or your spouse long life expectancy, this could be a real winner for you. Even if you're not that charitably inclined, Joe, we have lots of people that do this that say, wow, this is a good deal, and it feels good to give to charity, but really it's helping me a lot.
Right. I mean, like I said, if you plan a gift, right, the IRS is going to forgive that tax. And so this is a perfect example. You are giving it into this charitable trust. The charity is definitely going to get theirs. Now, another thing that you can look at is to say, man, I want to protect myself just in case if I die prematurely. Well, some people then set up another trust, a wealth replacement trust, and then they put maybe a second to die life insurance policy in there. Then that would go to the kids just in case you die prematurely. And I just feel like John Madden here. I just want to write boom. There you go. We got to take a break. We'll be back in a second. We're going to flip the show back to you. We're going to answer your email questions and wrap this show up. Show's called Your Money, Your Wealth. Don't go anywhere, folks.
Hi, my name is Brett Davey, CFP, Pure Financial Advisors, and this is your Question of the Week. So today's Question of the Week is, how does your overall portfolio structure determine the variance in your portfolio returns? There's a preconceived notion out there that a lot of your returns comes from a lot of speculation, a lot of short-term buying and selling, and a lot of overall white noise in the financial markets. But when you look at the academic research, that can't be further from the truth. The majority of the portfolio of your returns, especially the differential, the variation, is going to come from your weights between your equity side of your portfolio and then also the bond side of your portfolio. So when you look at it, are you 60% weighted in equities or 40% weighted in bonds? Or are you 70% weighted in equities or 30% weighted in bonds? That's going to determine the key variation in your overall returns.
Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson, Big Al Clopine hanging out, talking about charitable giving today. Talk about giving some money to quality charities and then also getting a little bit of a benefit for you in regards to tax. But of course, if you're going to give, that should be your first choice. Now, let's go to the true false, Al. Let's see what we got here today.
It's a good one. I can deduct all the cash contributions from my taxes that I make to charities each year. And the key word there, Joe, is all.
Yes, you've taught me that many times. Anytime you see all, it's always false.
It's false. That's not always true. So here's some limitations. I mean, generally that's true, sure. But as I mentioned last segment, if your cash contributions are more than 50% of your income, it's going to be limited. It will carry forward to the following year, but you can't take it currently. And then the second thing is a charitable contribution is an itemized deduction. Some of you don't even itemize. Some of you guys use the standard deduction. if you're using the standard deduction, a charitable contribution is not going to help you tax-wise, so just be aware of that.
All right, let's summarize, Al. We talked about a lot of different things today on how you can give to charity. You can give a check, cash, appreciated property. We talked a little bit about a donor advised fund where you can bunch up some contributions and get an immediate tax deduction. And then finally, we looked at a charitable remainder trust, or it could be called a tax exempt trust, where you can give a highly appreciated asset, put it into the trust, get an immediate tax deduction, get higher cash flow. The trust sells that property, does not pay any tax, and then at the end of you and your spouse's life, or it could be your kid's life, depending on how you set this up, at the remainder, then that's where the charity gets theirs. So everyone wins in most cases here. So hopefully that helped you out. But let's flip it back to our audience, Al. Let's go to some email questions here.
Yeah, let's get rolling. So we've got Lauren from Leucadia. And she asks, is there any benefit to naming a trust as the beneficiary of my retirement accounts? Man, Joe, this is right up your line. I'm going to let you answer this one.
We get this question quite often, don't we,
do.
Al? It's like, okay, well, here, I named the trust the beneficiary of my retirement account. There's pros and cons to this. In most cases, you always want to name a named beneficiary. That would be a spouse, a child, a niece, a nephew, a significant other, a friend, whatever. There's someone that has life expectancy, because here's what happens when you pass away with a retirement account, is that now the non-spouse beneficiary, let's say it's your child, then can spread out that tax liability over their lifetime. It's a really cool thing because they don't get hit with a huge tax bill. So some people say, well, here, I'm going to name my trust and that will avoid all taxes. Not necessarily. That could blow the thing up where you might have to distribute the account over 5 years. You might have to take the distributions to the highest age on that beneficiary of the trust. I mean, there's multiple things that can blow up with the trust. The only reason why, there's two main reasons why you want to name the trust the beneficiary. A, if you want to control the money from the grave. If you have children that you say, you know what, hey, if they get this big lump sum, I don't know what they're going to do, so let me control it with the trust. Second thing is that there's some creditor protection, all right, because now the law just stated that with an inherited IRA, okay, not a standard IRA, you're fully protected there, but when it passes to the next generation, now there's no creditor protection on that retirement account, because when they establish retirement accounts, it's for your retirement account. It's not a wealth transfer play. So if you want to protect it and you want to control the money from the grave, then by all means name that trust the beneficiary, but be careful. There's a lot of different things that you want to consider or look at when you name the trust the beneficiary of your retirement account. Al, next question.
Joe, that is well said, by the way. We actually did a whole show on that a couple weeks ago. Now, here's the next one. This is from Marty in La Jolla. Does my wife get a marital deduction for the funds in my retirement accounts if my retirement account proceeds are passed to my wife in a trust? All right, Marty, so you're thinking about your wife and what happens if you pass away. So generally any asset is that when you pass away that gets passed to your wife is going to get a marital deduction, meaning that no matter what the size of your estate is, there is no estate tax. And you guys may know this right now. So the estate tax exemption is $5,430,000 per person if you pass away. That simply means that if your estate is below that, there is no estate tax to pay. If it's above that, there's a 40% estate tax. But with husband and wife, assets are passed from one to the other. The survivor gets a marital deduction and there is no tax to pay currently. There is something to know, though, and that is this. When the first spouse passes away, if you feel like your assets, your joint assets are more than $5,430,000, the survivor should file an estate tax return within 9 months of the date that their spouse passed away. That establishes that $5.4 million to the departed spouse. The survivor still gets another $5.4 million. So, but yeah, Marty, the answer is yes.
Yeah, but then, Al, there's another wrinkle in the whole question here, because now he's talking about retirement accounts. So if it's an IRA, a 401k, I mean, don't name the trust if you have a living spouse. Name the spouse the primary beneficiary of that account, because then she'll have a little bit more control. She can keep it in your name, right, because that's important. Maybe she's under 59 and a half. She needs to start drawing income from it. She keeps it in yours, turns it into a spousal IRA or an inherited IRA for the spouse. Then she can take assets from it and not absorb the 10% penalty. If it's in the trust, depending on who the other beneficiaries are, it could blow the thing up. So I would always name your spouse the primary beneficiary, name your kids contingents, and then after that, name the trust. When it comes to retirement accounts, I guess the biggest rule of thumb over these last two email questions, just name a person, then name the trust.
Yeah, I agree with that, Joe. Unless you have kids that you don't trust with the money, and then that's a whole other
Well,
thing.
no, that's your family, Al. That's what you're doing with your estate plan.
We got one more question. This is what Jenny in San Marcos. Can I amend an irrevocable life insurance trust? Irrevocable life insurance. Well, that should be sort of your key. You cannot amend it. It's irrevocable. In fact, you can't even be the trustee. The reason why these trusts are set up is to take your life insurance outside of your estate so you don't have to pay taxes on that. But you can't be the trustee, so you can't amend it.
Yeah, I mean, it's irrevocable, hence the word. You can't really. So once you set up an irrevocable trust, you really want to make sure that you understand exactly what the game plan is, what the overall financial strategy is going to be, because once you set it up, it's irrevocable. So the answer is no. Woo! Talking a lot of charity today. Hopefully that helped you out a little bit. Join us next week because we got another wonderful show lined up. I don't know what we're going to talk about. We'll think about it over the next few days. For Big Al Clopine, my name's Joe Anderson, and guess what? You just watched another awesome episode of Your Money and It's Your Wealth. Happy weekend.